Hello and welcome to this video on stock control and lean production.
Stock control. Not that kind of stock control. We're talking about the stocks that businesses have. And stocks represent the raw materials, work in progress and finished goods held by a firm to enable production and meet customer demand. There are three main types of stock that a business might hold. Raw materials and components for making the products, partially made products, which we call work in progress, and the finished items on the shelf ready to be sold, finished goods. In this video we're going to look at three things: interpreting a stock control diagram, the term lean production, and the term just-in-time production. Let's start off by looking at why a business holds stocks. Well, businesses hold stocks, raw materials, so they can produce products. The first one. They also hold stocks on their shelves so they can sell to customers and meet their demand. They may also hold stocks in case they have any delays from suppliers and they can use what they already have to continue with their business. Having some stocks allows production to be efficient. All the stages of production can continue if there are some stocks from each previous stage of production. Having stocks can allow you to change how much you sell quite quickly if there's a change in demand, if you have a seasonal business. And it can provide a bit of a buffer between production processes. If you have a batch coming out of the oven and you have some stocks already, then you can continue with glazing the cooled ones while you're waiting for the existing products to cool, for example. How much should a business hold in terms of stock? Well, there's a number of issues. First of all, the business needs to have enough that they can satisfy the demand from the customers. Particularly an issue if demand is seasonal or unpredictable. The business also needs to consider that holding stock will tie up money. Money will be tied up in working capital. And lastly, holding stock, particularly perishable items, can be risky if those items will go off or if they will deteriorate over time. What are the costs of holding stock for a business? Well, first of all, you need to have them stored somewhere. So there's often a cost in terms of warehousing or equipment to handle the stocks. High amounts of stock means that the business has tied up cash, and if they've borrowed to maybe buy the stock, then they may be paying interest on the money they've borrowed. If whilst they're holding the stock it becomes obsolete, goes out of fashion, or becomes no longer in demand, then there's a risk there that they won't be able to sell it. So there's a cost of holding stocks. And lastly, there is a cost if the business runs out of stock. They will lose sales, they will lose goodwill, kind of favour with their customers. There may be stoppages or delays. So a number of costs associated with holding stock as well. We're going to move on to an important area now and look at how a business might try and control its stock. And one of the important things it might use is a stock control diagram. So it's important we have a good reflection of this in our notes. We're going to have three assumptions for our business here. The maximum amount of stock they can hold in their business is 200 units. They want at least 50 units at any given time. We're going to call buffer stock. It takes 7.5 time for their suppliers to supply them with stocks. 7.5 weeks, sorry. So let's start off. A stock control diagram has the level of stock on the y-axis and the number of weeks or time along the bottom axis. Now our first assumption here is that we couldn't hold more than 200 units at any given time. So that's the upper limit of our stock. So if we assume we start with 200, and then what will happen as we sell products over time is we would expect our stock to start falling. Now as we start to see it fall towards the bottom, we might have some alarm bells in our business saying, well actually if it gets too low, that's a problem. We don't want to run out of stock. To be safe, we probably want a minimum level of stock below which we don't let it drop. And we call this our buffer stock. So we don't want our level of stock to drop below 50, to have 50 worth of buffer stocks held in case there's a problem with delivery or a sudden increase in demand. We always want 50 units in stock. Then we would need to make an order so that when we got down to 50 units, an order would come in and we'd get back up to our higher level of stock. So here, after 15 weeks, we want an order to arrive. Now for an order to arrive, when do we need to notify our suppliers? Well, if we remember, there is a lead time of 7.5 weeks. So we're going to have to notify our supplier in 7.5 weeks time to get the stock in. So if we want it to arrive in week 15, we need to tell them after 7.5 weeks that we want the order, and then it will take 7.5 weeks to arrive, and we call that arrival time the lead time, the time it takes from placing the order to getting the delivery. So if we were to place the order, at what point, how far would our stock needed to have decreased to trigger that for us to do that? Well, if the stocks had got down to 125, it means we're 7.5 weeks away from reaching 50. So at this point here, we would need to place our order so that in 7.5 weeks time our order arrived and our stock levels were replenished. So 125 is our reorder level. If we were to place an order, once we got to 125, the stock would then arrive 7.5 weeks later in week 15. Imagine we ordered 150 units, our stocks would then be back up to their top, their limit, 200. And then as we sell more in week 16, 17, 18 and so on, our stock levels would start to go down, and as soon as we reach 125 in terms of our stock, what would the business do? As soon as we reach a stock level of 125, we would automatically, or someone manually, would place the order for more stock. It would take 7.5 weeks to come, that's the lead time. So in week 30 it would arrive, we'd be back up 200, the stocks would start to decline again. In week 45 stocks would arrive after the 7.5 week lead time when we got to 125, and so our stocks would be replenished. So this is called a stock control diagram, and the key features are the maximum stock level we can have, the limit, the minimum, the buffer stock level, the minimum we want to have at any given time, and so that gives us rise to a reorder level. At what point do we need to reorder so that the lead time is sufficient for the stock to arrive when we reach our buffer stock level? So our stock pattern will go like this over time, and then our reorder level is where we need to place our order. So we need to place an order here in week 7.5, we need to place an order here, we need to place an order here, and we do it when our stock levels got to as low as 125. So this is an important diagram. Make sure you have a good reflection of this in your notes. So the key features of a stock control chart: the maximum level, the reorder level, the lead time, the minimum stock level, and buffer stocks. So buffer stocks are an amount of stock held as a contingency, a backup in case of unexpected orders, so that such orders can be met, and in case of any delays from suppliers. Having buffer stocks is often called a just-in-case method of production, just in case we have some stocks in case anything goes wrong. So buffer stocks, some advantages of holding buffer stocks: well, you can quickly meet customer demand, you can respond to increases in demand, and you can continue with production even if there's a problem with some of your deliveries, although you wouldn't be able to do that forever. Disadvantages: well, you've always got money tied up in stock, so you're always holding stock. You also have to have storage, staff costs, insurance costs for the stock you've got stored, and there's a risk of it being wasteful if the stock goes out of date, or if it gets damaged, or if it goes obsolete, as we mentioned earlier. What are some implications of poor stock control? Well, it's a waste of resources if you don't control your stock very well. You may be unable to meet your customers' needs, and as a result you could have a damaged reputation. If you don't have poor stock control and you're continually running out of stock because you haven't got your reorders level sorted, then you could have machine or workers standing idle doing nothing while they're waiting for the stock to arrive. It's going to make you less competitive as a business. Also, if you don't control how much is coming in and out, how much stock you have, and you can't then value it, then what do you show on your statement of financial position? Okay, we've looked at stock as an issue and the stock control diagram. We're going to move on to lean production now. Lean production involves techniques that focus on cutting waste whilst maintaining or improving quality. So it's designing our production processes so that we use as little as possible in terms of resource, so we're not wasteful. We haven't got resources tied up in stock, for example, but keeping quality the same or improving quality. So once we take this definition down, reducing waste is a key part to increasing the efficiency through lean production. So minimizing our waste minimization is an important part of that. There are two techniques that we need to be aware of to implement, to use lean production methodology. The first is just in time and the second is Kaizen. And Kaizen we're going to look at a little bit later in the course, but we're going to look at just in time management of stock today. So let's take down the definition first of all. A technique used to minimize stock holdings at each stage of the production process, helping to minimize costs. So take down this example, perhaps pause this video and let's move on. Just in time. Not that just in time, this just in time. Let's imagine a scenario here where we have a car plant. And our car plant is using flow production and the products move continuously through each stage of production. And so we need supplies of steel, we need supply of plastic and metals and so on. Now the traditional model would be to have all our supplies, all our stock ordered and sitting in a warehouse. But is that the most efficient for the business? Think of the costs involved here. We've bought all this stock and it's sitting there. We've got to hire the warehouse, we've got to pay staff to supervise it, we've got to pay staff to deliver it to the production line, we've got to have it insured. What if something goes wrong with it? There's a leak and some of it gets damaged. This isn't really the most efficient way of organising our production. Instead, we might use just in time, and that is when resources or supplies arrive literally just in time to go onto the production process. So for example, if we were making 10 cars today, a lorry would turn up with the steel for 10 cars, drop it off, and that would go into the production line. The next day, another lorry would arrive just as we need those supplies, deliver them, drop them off, and it would go into the production line. The next day, again, exactly the same. The supplies arrive just as they're needed in the production process. They turn up, they're dropped off, and then the delivery is over. And this process happens continually. Products are delivered just as they're required on each stage of the production line, rather than having a large warehouse with all our stocks on it. So just-in-time management of stock is a lean production technique. What are the benefits and the difficulties of this approach? Well, let's look at the benefits first of all. You don't have to hold as much stock at any given time because it's arriving, being assembled, produced, and turning into final products. So less money is tied up, less working capital is required. There's less risk of the stocks being ruined or going obsolete. There's lower costs of security and insurance, and it avoids you having large numbers of stocks unsold. Any difficulties? Well, there's little room for error. You're very reliant on your suppliers being efficient and actually arriving when they say they will. If you get an unexpected order and you don't have any stocks to turn it into products, then it's harder to meet any unexpected orders. Any delays, if your lorries are late one day, then that's it, production stops. Whereas if you had stocks in your warehouse, you could possibly continue. It's quite complex and it costs a lot to put in place. You need all those deliveries coming in, you need to be able to accept them and efficiently integrate them into your production process. So in this video, we've looked at implementing or introducing a stock control diagram, we've looked at lean production, and we've looked at just-in-time production. That's it. Thanks very much.